I'm Osborne Foreman, and in this video I'm going to break down all of the stock market taxes and show you how to invest in the UK tax-free. And if you find the video useful or you find something new and learn, then please drop one of these to support the channel. Firstly, it's worth understanding that I am simply just a young lad on the internet with a passion for finance and investing. And in that way, I am in no way a financed or licensed financial professional, so please do not take this in any way as financial advice, and please do your own research. There are a few different taxes available to stock market investors, so it's worth knowing about them so that we can actively try to avoid them. An example of one of these taxes is capital gains tax, and this is taken from your gains after selling or disposing of an investment. We also have a dividends tax, which is based on your income tax band. There's also stamp duty or stamp duty reserve tax, which is 0.5% on investment purchases, although this is only if done electronically or if the sum is over £1,000 non-electronically. Lastly, we have dividend withholding taxes, and this is applied to purchasing foreign equities or stocks, and this usually means that a part of the dividend is kept by that native country as tax. Whilst it may seem like the last two available taxes are unavoidable, there are a few secret ways or lesser known ways that we can actually avoid these, which I will talk about very shortly on how we can lessen them or nullify them completely. In the UK, it's also worth noting that we have quite generous tax allowances. An example of this would be our capital gains tax allowance and dividend tax allowance. In the current financial year of 2020 to 2021, we have a capital gains tax allowance of £12,300, which had increased by £300 since the previous tax year of 2019 to 2020. Furthermore, we have a dividend tax allowance of £2,000 per year. However, the capital gains tax can also be taken from property investment gains, so do be careful and try to do your own research where possible, as this isn't just tied to stock investment gains. Once you go over these said allowances, you would obviously be paying taxes, but there are some investment accounts and vehicles in which you can actively avoid these. It's also worth noting that if you're a basic rate taxpayer, you would likely pay 10% on all capital gains that aren't in your personal tax allowance. Higher or above income tax rate bands will likely be paying 20% on all capital gains from investments. It's also worth noting that you can claim losses. So say you made a loss on your investment, this can be claimed against your taxes, but it's worth contacting HMRC or using the gov.co.uk website to find out more. As for dividends, they aren't as generous in the higher rate or above tax rate bands. This means that if you are a higher rate taxpayer, you will be paying either 32.5% on your dividend income, or if you're an additional rate taxpayer, you'll be paying 38.1% on your dividend income. However, if you are a basic rate taxpayer, then you will actually be paying 7.5% tax on your income of dividends, which is quite a strong area. So if you are obviously earning less, then dividends could be better for those lower earners, whereas capital gains could be better for the higher earners. I believe these are added to your overall income for the tax year, and this would mean that if you earn absolutely nothing in the tax year but dividends, you could earn up to £37,500 in dividends at the basic tax rate of 7.5%, but this doesn't account for the dividend allowance or the personal tax allowance, which you would need to do further research. But obviously, amounts above that threshold would be subject to higher rate tax. Dividend withholding taxes on foreign stocks is usually unavoidable, but for the likes of US withholding tax, you can fill out a W8-BEN form, which allows you to reduce the withholding tax from 30% to 15%. You can, however, reduce it further, and this comes to a little bit more of niche knowledge. You can do this with specific brokers only, and you would have to do this in a self-invested personal pension. This is because the US identifies it as a conventional pension fund, and no withholding tax would therefore be applied, but you need to actively reach out to your broker so that they can apply for this. And as far as I know, little amounts of brokers actively do this, as it is very time consuming. I'm pretty sure, but not 100% certain, that Hargreaves Lansdown do this for their customers, but but you'll have to contact your broker to find out more. And then what would happen after this is that you would have that additional 15% removed, so that you would have absolutely zero withholding tax in the US. I believe you can do this to other places, but then again, you would have to do further research onto the matter. Stamp duty, despite being applied on all listed investment purchases, is actually avoidable. This is because companies listed in the AIM or alternative investment market on the London Stock Exchange are classified as unlisted businesses. This means they are not subject to stamp duty, meaning you could purchase stocks in these AIM markets and not pay stamp duty whatsoever. These, however, are often regarded as more risky compared to the bigger businesses because they are less regulated in the AIM market, and they're also of a smaller size typically, meaning that they can be a lot more volatile or less risky or more subject to potentially fraudulent balance sheets or businesses. So please be careful if deciding to invest in AIM stocks, but if you are interested in buying AIM stocks, then you can sign up to Trading 212 and get a free share if you use my link in the description down below and deposit just £1. Fortunately, in the UK, avoiding capital gains or dividends tax is actually quite simple. And you can do this using specific investment accounts. The most commonly known investment account in the UK that can do this is an ISA or individual savings account. Since we're talking about the stock market, it will be more specifically a stocks and shares investment ISA. These are tax-free but only have an annual deposit limit of £20,000 per year. All money inside of the ISA shelter will not be taxed, but stamp duty will apply on investments not in the AIM market, and unfortunately withholding tax will be capped at 15% as it is not classified as a pension fund, but you can still sign that W8-BEN form. Another possible investment shelter is one that I'd mentioned earlier, the SIP, or the self-invested personal pension, and this isn't as good as an ISA for tax sheltering, but it certainly has got its own advantages. This is because you can deposit more money into a SIP per year, which is £40,000 per tax year, but you also get tax relief on deposits. This means that if you deposit money into a SIP, you will automatically have 20% tax relief applied, and if you're a higher rate or additional rate income earner, then you can contact your broker and get more tax relief. However, the catch is that they have a lifetime allowance. This is currently £1.07 million, and if you go above this threshold, that all investments above this will be taxed at either 55% at lump sum or 25% plus income tax on drawdown. Furthermore, when you come to withdraw this, you are required to be 55 or 57 from 2028 onwards, and this money, only the first 25% is tax-free, whereas the rest is subject to standard taxes. So whilst this is a great investment vehicle to completely nullify withholding tax and compound your wealth over the longer term, at the end you will eventually be taxed. And so it's based on pre-tax money, and therefore you will receive pre-tax money, but then it will be taxed when you withdraw it. But these investment accounts I have listed, such as the ISA and SIP, allow you to avoid capital gains and dividend taxes so that you can grow and compound your wealth over the longer term and hopefully be either financially free by retirement or retire potentially early in the case of an ISA. If you're interested in how to choose the best investment platform and account, then click the card at the top right of the video. Thank you for watching. Have a great weekend.